Welcome back to On the Tape. I have a very special guest, somebody who's returning to the pod. That would be Alfonso Peccatiello. He is the author of The Macro Compass. He is a great follow on Twitter. He is at Macro Alf. Alf, welcome back, bud.
It's always a pleasure to be here with you. Thanks for having me back.
All right. Before we get into some of the work, and again, I've followed you. I first found you on Twitter, like I think a lot of us did, maybe about a year ago. I think you started kind of blogging just a little bit. I think you were doing it under the Macro Compass moniker, but you've really taken off. I want to say in the last 6 to 9 months, your following has become huge, both on social and by what I can tell as far as subscriptions to the Macro Compass. It's one of my first reads when it comes out each day. I've been a subscriber for a while. Talk to us a little bit before we're gonna get into some of the recent comments, some of the recent posts, some of your outlook for how to invest in Q2, how you're thinking about the yield curve, the Fed's credibility at this point, what they're likely to do, and what the market is likely to perceive their course of action after their May 3rd meeting. But talk to us a little bit about your journey. I think a lot of our listeners probably heard about you, saw you last year, and you're building a pretty large community right now. And you can see that by your engagement on social. But talk to us a little bit about the Macro Alf and what you've been able to build in the last year or so.
So I, before turning into a social influencer, whatever it's called these days, I used to run a $20 billion fund for ING, which is a European bank, actually a global bank. And I did that for 8 years. So I was in Wall Street, basically, running money. And at some point, I decided I actually wanted to do something by myself, set up shop and try to see if I can freely speak out my mind to the broader world, which is what I did through the Macro Compass, first through social media, but then I realized, I needed a broader platform that allowed me to elaborate more, build models, share portfolios with my clients, etc., which has been done on the Macro Compass, which today serves, I think, quite thousands of macro investors around the world, being sophisticated retail people, hedge funds, institutional investors all over the place. What I tend to do at the end is just to decompose what's going on in macro, thanks to my expertise, especially in bond markets, and make it actionable for people and in plain English. And it seems there is quite an appetite for that out there, which makes me very, very happy.
Yeah, well, listen, this is your third time back on our programs, and we often quote your work, whether it's your tweets or whether it's your posts there. So we really appreciate it. And I'll just say this, if you're listening to this right now, I am not trained the way Alf is trained. Guy is not. Danny definitely has some macro chops. But to me, to kind of have some sort of understanding of the macro, it's really important for my broader thesis, right? I like to think, top down and then work on individual names or sectors, bottoms up, and kind of meet in the middle a bit. So that's why, people like this are very important to me. And that's why we spend a lot of time on the macro, but usually with smarter people than us. All right, let's talk about this. You were last on December 2nd with Guy and Danny, and you spent a bit of time talking about that interplay, like you said, with the interest rate volatility and what it likely meant to you about other risk assets, which had been less volatile. Last year in the stock market here, it was upper left to the bottom right, but it was very orderly, right? In many ways. And we had spikes in the VIX, to the mid 20s. Maybe it got, over 30, that sort of thing, but it was very brief. But it was really that bond market volatility. And, you kind of suggested that something was likely to break. And we did have some things break early this year. Talk to us a little bit about how your outlook at the end of 22 has played out into 2023. And now how are you thinking about, the bond market volatility has definitely calmed a bit here, but we also have readings of the equity market volatility at levels that we haven't seen since the S&P was at all-time highs in the first week of January of 2022 when it was trading at 4,800.
Of course, excellent intro from your end. Look, the main thesis back then was that this higher for longer mantra would only be in reality higher until something breaks. It has always been the case, and this time it ended up being a liquidity stress in the banking sector. Funnily enough, because it was not a credit stress, but a liquidity stress, it ended up boosting the market higher through Fed intervention, which calmed markets, injected bank reserves and liquidity into the system. And we ended up, through the Fed tools, calming down this very idiosyncratic liquidity stress. It wasn't a systemic stress at all, but it ended up stimulating the Federal Reserve to intervene again. And markets are just so used to buy the dip and rally and kill volatility whenever they smell the Federal Reserve is pivoting, right? The market has been trained for 10 years to do exactly that. Front load Fed pivots, buy the dip whenever you smell the Fed is doing something accommodative. It has always worked. And so we are seeing muscle memory at work here, if you ask me. We are seeing this banking mayhem hysteria, which was out there in March. Luckily, on the macro compass, I could guide people through what was happening. It was an idiosyncratic liquidity stress that the Fed could backstop. They did, I think, very promptly so. And this has ended up calming markets down to the point where, because realized volatility is so low, because the S&P doesn't go anywhere, because we don't have drawdowns, because the bond market is now trending in a range, all this leveraged community, all these hedge funds, volatility targeting funds, CTAs, momentum traders, they have now the risk budget to jump back in because the market isn't that volatile anymore. And when that input becomes, hey, look, the market isn't jumping left, right, and center, volatility is calming down, you actually get risk budget to get back into the market, and you see this slow grind up that we see. Every time we hear that this is a new bull market. We have heard this in July last year. We have heard it as well in November last year. We keep hearing it at every iteration. It is a mechanical, flow-driven, volatility compression-driven bear market rally.
Yeah, it's interesting. So let's just look at the S&P, for instance. From that October low, we're up nearly 20%. And again, so we've seen plenty of proclamations about a new bull market that's in place. We're up about 9% from those kind of mid-March lows in the height of the fears of that little banking crisis. But the market seems stuck. And I guess to your point about the muscle memory of any time the Fed appears to intervene or might pivot, right? I mean, that's been the playbook really since, 2010 or so, and I've mentioned this in a couple pods over the last few weeks. I mean, if you were fully invested and that is your kind of playbook there, if you want to be tactical and hedge, and this is what a lot of the people I think that you speak to and that I speak to on the institutional front, you could look, let's just say you wanted to look out to May 5th. And let's say that week, we know that on that Friday, May 5th expiration, we have the April jobs report. The day before, we have the biggest equity on the planet, Apple, is going to report earnings. The day before that, we have a very anticipated Fed meeting, right? If you wanted to buy an at-the-money put in the S&P 500, it would cost you 1.25%. Okay, 1.25% to hedge a portfolio that maps towards the S&P 500. Now, you've been in the game for a long time. You might not be somebody who uses those sorts of instruments to hedge, but you look at that as an input to give you a sense for the sort of fear that is out there in the market. When you hear something like that, Alf, what does that say to you at a time? It says to me, ultimate complacency right now. And so I'm just curious, like when you see a data point like that, how does it want you to be positioned right here?
Well, look, you want to buy insurance not when the house is on fire, right? Because everybody else is bidding up insurance. And there were people buying out of the money puts extremely expensive on banks exactly at the peak of the 15-17 March banking hysteria out there. That obviously is the wrong idea in the first place because you just spend too much money on the premium. So obviously, with hindsight, if you do 50 trades like that and you tend to buy insurance when the house is on fire, you are not going to get paid back for it at the end of the 50 trades, right? On the other hand, when insurance is cheap, then it's when you get interested. Now, what I do at the macro compass is not only look at options in the stock market, but I also look at options in the bond market, in the FX space, in credits, in all asset classes, and I try to understand exactly that. Is the market beating up insurance premium? Is the market worried? And the answer I get all over the place right now is no, not at all. Even if you look at emerging markets, there is an incredible complacency right now that you can go and hide and buy Brazilian stocks and Mexican peso and all these emerging market exposures, and they're going to be fine. It's going to be great. Even Europe now seems to be a safe haven all of a sudden. And when you hear that, last time that Europe was considered a safe haven, and that the ECB was hiking while the Federal Reserve was likely to stop, which is my base case after summer. Last time the ECB was hiking, when the Fed was stopping, was in summer 2008 and in summer 2011. I mean, shall I remind people what happened later in 2008 and in 2012, we had the European debt crisis as well. So normally these periods where things appear very funny and people have very relaxed takes on places that are normally considered more risky than the US, this is when I get particularly interested in wanting to buy protection.
Let's talk a little bit about one of those events that I think is going to take front and center, especially as we get through the kind of bulk of U.S. Q1 earnings here, and that's going to be the Fed. And you had a tweet the other day I thought was really interesting, and we'll put it in the show notes here. In March of 2008, the Fed was not yet sure about a recession while we were in the midst of the mother of all financial crises. Don't trust the Fed to tell you when we're in that cycle. So I thought that was really interesting. And talk to me a little bit about what you think their credibility is right here. And what do you think is the most, like, what should investors, what should readers of your Macro Compass, what should listeners of this podcast, what should they be focused on to get a sense whether the U.S. is going to be headed into a recession? And let's talk about the positioning. And you are, while you sound cautious on the macro, you are constructive. There are ways to make money in a macro environment where there's a lot of uncertainty. So I'm just curious how you're thinking about this, because it seems like in about a month from now, we're going to have a lot more certainty about at least the path forward for the Fed once we have Fed funds at about 5%.
So the Fed is one and done in May. They'll hike 25 basis points in May, and then I think they'll stop. They'll be done with it. Now, when it comes to markets, generally markets like that in the first instance because the uncertainty about the Fed hiking path ahead is basically taken out, right? You know the Fed is going to be sticking at 5% for as long as they can. The problem is, as long as they can means until they have broken something for good. So when it comes to recessionary signals, right, what you want to look out for is actually a couple of things here. The first is, look, the labor market is already been weakening under the surface for 3 to 6 months. And how do you look at that? Is not by looking at non-farm payrolls. This data is statistically very volatile, sometimes subject to large revisions ex post. What you want to look at is the internals of the job market, as I call it. So two things in particular. The first is the industries that are hiring on a net basis and not hiring anymore. Just look at which industries are adding jobs. And right now we're looking at education, healthcare, government. Do they sound to you as very pro-cyclical industries? Not really, right? The pro-cyclical industries, housing market, financials, tech, cyclical industries in general are not hiring at all at the same pace they were hiring 6 months ago. Second indicator, again, look under the surface. That's what we do at the Macro Compass. Temporary workers hiring has collapsed already since the second half of 2022. Why does that matter? When you're expanding your hiring activity, you first hire temporary workers to fill in the gap, and then you move to permanent workers. When you're firing people, who do you fire first? You fire your temp workers. They have more flexible contracts. They're easy to dispose as they're easy to hire back. Well, temporary workers have been falling in the US for a while, and even full-time workers are not being hired on a net basis anymore that much. So guys, the internals of the job market are weakening. And we should pay attention to that because every time the job market starts to weaken, it is the last shoe to fall really to announce to us we're in a recession. The Fed and the NBER are going to actually recognize that we're in a recession not earlier than 3 to 6 months after we are already in it. You just said the March 2008 example, I think is great. We were in it already. And the Fed said, well, we maybe see a mild recession. Yeah, really? So don't wait for the Fed to tell you you're in it.
You know what's interesting? And I want to make one point about the firing of workers. You start with temp and then you go to the permanent, like you just said here. You know, in this last, let's call it 3 to 6 months, and some of the hardest hit names were obviously tech, and these were also some of the biggest, employers in the last 2 to 3 years. You know, companies like Meta were hiring tens of thousands of employees, since let's say the pandemic. And today there's a headline. We're recording this Friday morning that Meta is readying more layoffs. They're slowing hiring. All this, and the stock's down. and the stock's down because the stock has rallied 100% after declining 75% from its all-time highs. You get to a point where they've cut to the bone, and then you start thinking about what else are they going to cut, whether it's CapEx, whether, like, there's a whole host of things that I think, and these are the sorts of things that we're going to learn, I think, on a single stock level. This is on the more micro level as we get into the earnings season. The other thing, Alf, and I don't know if you caught this week, and I have a lot of PTSD, as many people do who lived through the financial crisis here, and going back to the highs in the stock market in November of 2007, I always like to think of like things to bookmark here. And I remember it was Cisco, and Cisco was one of the largest tech companies on the planet back then by revenue. And they had exposure to enterprise, the exposure to government, geographies all over the world, that sort of thing. And it was a really interesting bellwether. And in November of 07, they had a miss and a guide down. And I remember thinking and looking at the kind of internals of that and what you would, if you wanted to extrapolate that, it really would have been pretty bad. It was interesting. Earlier this week, we had this company called CDW, and they're a big reseller of both hardware and software and services. And it was a really bad guide. The stock was down 25%. And interestingly, Cisco, since that negative report, has been down 10% in a straight line. Now, that company is a smaller company, but I like to think about some things like that. The other one was Tesla this week, and it was a story that is a bit like a cult, right? Following, and obviously the products and the CEO and the aura around it. But here's a company where the fundamentals are getting worse, and we haven't even had a recession yet. And so in a higher interest rate environment, and it takes really lending to buy their products, and they keep cutting prices, and the margins are under pressure, and the backlog is going lower, and the inventories are going higher. And if this was not a cult-like story, that stock would be much lower. So how much do you think about some of these individual stories when you're kind of making this macro mosaic?
I do, and what you're saying is really relevant because across the tech sector, we have already gotten some shaky earnings reports over the last few quarters with some so-so guidance, right? So the trend is very clear, even at big tech level, if you ask me. I expect earnings to deteriorate further. And actually, the bear market has two legs. The first one is valuations repricing. And we have seen that in 2022. I mean, earnings weren't falling that much at that point yet, but it was the repricing of risk-free rates. I mean, you moved from 0% yield to 5% yields at some point. So obviously your cash flows have to be discounted differently. It's a valuation story. But people think that we're done with it. I mean, that's it. A bear market also has a second leg, which is an earnings per share leg. It's the moment when the labor market suffers. It's the 2001 moment, if you remember. In 2000, we repriced valuations. The dot-com bubble basically burst, in other words, but it was in 2001 when earnings started to fall. And in 2001, the Federal Reserve cut interest rates by 475 basis points in a year. That will be the equivalent of bringing rates to zero, effectively, by mid-2024. And ask me, what did the S&P do? The year when the Fed cut interest rates by 475 basis points, the mother of all Fed pivots, the S&P dropped another 12% that year. Why? Because earnings were collapsing. People were getting fired. Real money was selling their equities to raise capital because earnings were coming down. Jobs were lost. That's not the moment when people jump into the stock market. We haven't seen yet that second leg down in earnings, which are suggesting when looking at these companies that are sometimes considered to be the bellwether of overall economic activity. So we are going to get there. Things are very calm now, I think, which is a great opportunity to position and buy some insurance when nobody thinks they need it. This is the same story. Do you remember the higher for longer narrative of February? I mean, we were never going to cut rates. Rates were going to be at 5%, 6% maybe. Economists were calling for 7% Fed funds. Buying call option on TLT, buying bond optionality, basically, to protect your portfolio was as cheap as it could ever be, right? So maybe you weren't right. Maybe the banking crisis didn't happen. You didn't know with hindsight, but that was cheap optionality. And that's the same way I'm looking at it right now when I look at puts on the S&P 500.
Well, and you could throw gold in that category too back then too. And one theme that as I read your posts, you really like to kind of lead readers towards away actually from lagging indicators. You just mentioned as you think about the jobs report, but you had a tweet out yesterday on leading indicators. The U.S. Conference Board (LEI) takes the 10 most effective leading indicators and aggregates them into an index. The year-over-year change dropped further below 7% over the last 40 years. Every time this indicator drops below that, it stays there for 2+ months. We are in a recession, 100% hit rate. Talk to me a little bit about that. David Rosenberg, who I really appreciate his work, and he's come on the pod a bunch. He was also talking about this yesterday in some of his work. So talk to us about how investors should be thinking about leading indicators.
Yeah, look, I mean, the Conference Board leading indicator is interesting because it does some of the work for you. They look at the 10 top statistically significant leading indicators in the US and they aggregate them all in an index. And then the index is published every month. It's been declining for 12 months in a row. Okay, so I ran a historical analysis looking at 50 years, and every time that this indicator prints negative for 2 or more consecutive months, so it's not just a blip or a false signal, but it prints negative for more consecutive months, then you're basically always looking at the recession 7 to 8 months out. Now, the 2 negative prints happened by September last year. So you're looking basically with a normal leading time at a recession starting round about now. It might be now, it might be May, it might be June, but you're looking at recessionary probabilities increasing. The other indicator that I like looking at is the creation of money for the private sector. So I want to look at credit. I want to look at money that reaches our pocket, guys. I mean, I don't care about financial money in that context. All these QE, bank reserves, financial engineering. I want to check how much money we and corporates are getting in our pockets to spend on goods and services. And that amount of money exploded in 2020 and early 21 because the government was doing deficits. You know, they were sending checks at home to people and banks were lending because the government were guaranteeing losses. But that has stopped a long while ago. So we haven't been expanding credit to the real economy at the same pace, not at all. Even before the banking stress, credit conditions were tightening, lending standards were tightening, which means corporates, households, people involved in the housing market are having a hard time getting credit on. And when the private sector is choked for credit, things slow down. It's natural. You have less access to leverage, less access to cheap credit. Things slow down. My credit impulse that I publish on the Macro Compass, it aggregates the 5 largest economies in the world and it checks how much money is being created, looks really, really negative. It looks at 2007 levels, just before the great financial crisis. So does it mean we're going to get another one now? I don't know, but it's sure I don't want to be allocated 100% into equities, 0% into defensive positions, because that's not what my macro models are suggesting at all.
Yeah, it's interesting. We just got through the U.S. Money Center Bank earnings, and it seemed like for the most part, most of the CEOs were fairly constructive on the consumer, right? But you and I know that, again, maybe that is just kind of an overlay of what the stock market has done this year, because we're seeing the housing data not particularly good, right? And so you're seeing, savings rates come in, you're seeing consumer credit go up to levels that we've never seen. And, the one piece of the puzzle here is that we still have an unemployment rate at 3.5%, but under the hood, to your point, some of the data as it relates to the jobs market is getting weaker. And if that were to shoot up to 4%, I think that's how this kind of slowdown really starts to accelerate a little bit. So let me just say one thing. So if you say there's a good chance that we could be starting the recession now, what does some of your work suggest about how the stock market reacts as we're about to start a recession, right? So over history, it's, I don't think there are too many instances where the stock market has bottomed prior to a recession starting.
I looked at 100 years history, and the stock market has basically almost never bottomed before a recession. Never. So is this time different? 4 very expensive words in finance to use. Now, obviously, if you don't expect a recession, it might well be that the market just chugs along. It just goes there slowly but surely, slow grind up. If you expect a recession to happen, and look, the Federal Reserve is making everything they can to make it happen. They're going to keep rates now at 5% until something bad happens. I mean, you are literally being paid to wait. That's the advantage you have this time. You can keep money in T-bills, getting paid 5% to wait until the Federal Reserve does something really bad and something really breaks of systemic importance. And that moment is going to happen. Maybe it doesn't happen in a month or two, maybe it happens in 3 months, but the expected return in investing into high beta risky assets at this point in the cycle, where things are already slowing, where a recession should be considered a base case, I think, in a couple of months, and the Federal Reserve is making sure they keep policy tight until something actually breaks, I think the expected return in investing in risk assets is pretty bad, especially as you're paid 5% a year risk-free to wait.
All right. So I have two questions. And one, you referenced this before. So if you're waiting because your muscle memory is to buy stocks because the Fed is going to start to lower rates, and you just gave the example in '01 where Fed funds was above 6% and it basically went to 1%. And then in '07, it was above 5% and basically went to zero. In both instances, the S&P 500 got cut in half, okay, from its highs, okay? So that's a really important factor. So if you look at this chart of Fed funds, you know that we just went from 0 to 5%, and they're going to keep it there until what you just said, something's going to break. And at our lows last year, the S&P was down 27%. And we also just said in 100 years, your data suggests that the market does not bottom before the recession. So you put all that together and you say to yourself, it's not a great spot to be buying stocks right here. But here's the other point. And you just said this, and I keep getting this question, and this is really important, okay? You're getting paid to put your money in short-term treasuries, okay? But here's the thing. What if the U.S. Treasury defaults on its debts? What if we have a 2011 situation where this Fed, if we have this debt ceiling tripped, how comfortable are you having your money in short-term treasuries?
Well, that means you're going to get delayed on the payments, right? So basically, they're not going to be paying you until they figure out how to resolve the problem. So effectively, your 5% a year will be watered down because you'll be getting your money back later, right? I mean, when I say you get paid risk-free rates, it means sooner or later you're going to get your money back. I expect that the debt ceiling will be resolved, as it every time is. It's a political weapon at the end of the day, right? And it's a political discussion. But the broader perspective here is the following. I've been hearing from a lot of my hedge funds and macro investors that are subscribed to the Macro Compass questions like, well, Alf, inflation has become structural, right? I mean, we're going to have inflation trending between 3 and 5%, and, it's going to be there because of deglobalization and onshoring and all of this, post-pandemic restructuring of the world. So that means the Fed is not going to cut rates anymore back to, 1% or 2%. At best, they're going to cut rates to 3%. Well, guys, if we get a proper recession as I expect, Fed funds are going to zero. I want to repeat it again, zero. And why? Because people confuse trends with cycles. So a long-term trend might well be that inflation has become entrenched. It might well be, but it will take a decade for that trend to play out. In the meantime, if you get a proper recession with housing market deleveraging, with people losing their jobs, with inflation collapsing, and an average recession brings inflation down by 7 percentage points, guys. I mean, a recession is the perfect cure for inflation. It's a very painful and expensive one, but it works. It sure works. So if we get a recession there and inflation collapses and people are losing their jobs and the housing market is deleveraging, why would the Fed not be forced to cut rates all the way back to 1 or 0%? I don't see any particular reason. Yes, then inflation becomes entrenched, and later on, in 5 or 10 years, we're looking at Fed funds that are higher than average, but in the recessionary cycle, the Fed will have their hands tied and they will be forced to cut rates back to 0%. So from that perspective, the way I see it is you got to buy some bonds at some point. Don't be greedy. Everybody's looking at, but 10-year treasuries might be again at 4%. I want to wait exactly for that moment to buy them. And I'm like, but what if you have 0 bonds in your portfolio and the Fed is cutting all the way to 0% just because you were greedy for a few basis points? So my take here is accumulate a bit of fixed income position in your portfolio because it works well. The dollar, everybody seems to be willing to sell the dollar now down because Europe is better than the US. That's a story we hear. Buy Brazilian real because emerging markets are safe. Guys, if we get a global recession and a deleveraging episode, I can guarantee you want dollars, not Brazilian real and not euro. So now that they're on sale, I would buy some of those too. And when it comes to the equity market, just act defensive. I mean, there is no reason to chase this unprofitable tech rally. You don't want unprofitable tech companies in your portfolios during a recession. If you have to have some equities, choose strong balance sheet companies, more defensive sectors, anti-cyclical sectors, not a bunch of unprofitable tech companies, please.
You know, it's funny. One of my themes has been, when we get towards a bottom, I want Qs and twos. And when you think of the QQQ and you think of the top 6 or 7 names, yeah, they're trading a bit expensive to their historical, but I think it is because of that safety. You saw the outperformance by those names in March, right, when we had this kind of banking turmoil. And the other one is I am of also the belief that when I say twos, I really mean at some point we're going to have that downdraft in yields, right? But I want to be in larger defensive tech that do have some cyclical exposure, but really do have those moats as it relates to, they're basically monopolies. They have massive balance sheets, all the like here. Well, listen, Alf, it was really great to do this. I hope we can do it more often. Talk to our people about where they can find you. Obviously, Twitter, you put a lot of great content out, but like if you really want the Alf, a couple times, 2-3 times a week, more in depth, the Macro Compass is just a great read. It's really digestible. And I hope as we kind of had this conversation, I don't think there's anything, if you're just somebody who kind of, really likes to pick stocks and you're very domestically focused, that sort of thing. I think when you hear someone like him talk about the dollar, the Dixie was trading at 115 6 months ago. Here it is down at 101.5, and trying to understand how does that affect your U.S. multinational holdings? Why might it be a good opportunity? Why might we see a sea change in rates in 6 to 9 months, and for what reasons, and how that might affect your longer duration assets that you hold? All of that stuff, that's all in the Macro Compass. Alf, where can they find you?
TheMacroCompass.com is the website, and all I do there multiple times a week is I take all the mistakes that I've made and all the things that I learned when I run $20 billion, and I've made plenty of them, I can guarantee, and I've learned plenty of things. And I take what's happening across the world, try to break it down in plain English, make it digestible, and make it actionable. So you'll have tactical trade ideas, ETF portfolios, simple to have a look at the asset allocation I'm having, trying to translate my macro models and my experience into action. All of that is on themacrocompass.com.
All right, my man. Well, I appreciate you coming back, and I hope to do it again very soon. So thanks a lot, Alfonso Peccatiello.
Thank you very much.